Hi, this is Jim Pierce, Chief Investment Strategist for PF Pro with a PF Pro video update on Wednesday, May 31st, 2023. Wall Street is running scared. The conversation no longer centers around inflation and monetary policy. Now the worry is that our elected officials in Washington will fail to ratify a solution to the federal debt limit crisis. You can see that concern in the financial markets. The yield on the 6-month Treasury bill rose above 5.5% this week, surpassing its peak yield 17 years ago in the months leading up to the Great Recession. And here I've got a chart of the 6-month Treasury bill yield, and way over here is March of 2007, and it comes close to 5.5%, and then it quickly dives down as the Fed cut interest rates to try to bring the country out of recession. And then you can see a long gradual build up. Now I'm going to show you the past year. And you can see a year ago, just as the Fed was starting to raise rates, it was around 1.5%. Now it's up to 5.5%. And let's look year to date. You can see, especially in the last month, as it's become increasingly apparent that the Biden administration and leaders in Congress, they say they have a deal in principle, but at the same time, you know how that goes. So we'll see what happens. But that reflects a lot of nervousness that maybe there may not be a solution, at least not before it expires. So that's one data point to keep a close eye on. You can also see it in call option time premiums. I don't really have a graphic to show you other than the portfolio table, which is in the body of this update. And the reason, call option premiums consist of two pieces: intrinsic value, which is the difference between that call option's strike price and the current share price of the underlying security, plus a time premium, which essentially reflects optimism, how much that underlying security may move between now and when it expires. So in other words, optimism is in short supply on Wall Street, so the time premiums are getting smaller, leaving only the intrinsic values, which are also getting smaller when stocks go down on fears that the odds of a recession are going up. However, that dynamic may not last much longer. The same chart I showed you last month of the S&P 500 during the past 12 months, where the peaks of the cycles all bump up at technical resistance around 4,200, but the bottoms of those cycles are getting progressively higher, and we're still pushing towards some date that looks to be in about a month, where we will reach the end of what essentially is a vector formed by those two lines. If this pattern holds true to form, it may have one more down cycle to go through, and you can see that it's bumping up against the top, but there's still some space to the right. At that time, it's likely to make a big move one way or the other, and the timing of that event could coincide with a possible resolution to the federal debt limit crisis. They're throwing around a date of June 5th or June 6th. A friend of mine who was the former Comptroller General of the United States tells me really they could even push it out a few more weeks if they really, really had to. And if that's true, then not to sound too cynical, but I think they probably will. When that happens, the price of our call options could appreciate significantly. Not only would their intrinsic values increase, but their time premium should also rise in response to increasing optimism. In other words, what I'm saying to you is keep the faith. I know it's kind of a downer to see a lot of these red numbers, but this could change quickly. The same macroeconomic pressures that have conspired to suppress call option premiums could quickly reverse direction. I have a feeling this summer could witness an end to the malaise that has caused the stock market to gain no new ground over the past 2 years. That's this month's PF Pro video update, and I look forward to talking to you another month. Thank you.